All right, let's kick it all off. Stephen Weiss, we got a lot going on today. We got numbers out of Nike. We got numbers out of FedEx, consumer confidence. I pointed to a couple of other things that maybe others are poo-pooing. To what do you ascribe today's sort of sudden strength to?
I think it's optimism that's probably not really justified. If Nike and that, I guess that's what most people point to, Nike and FedEx reporting, I would say Nike, a really good quarter, FedEx, an okay quarter. But here's the story of those two. Let's talk about FedEx first. FedEx has missed, what, 4 out of the last 5 quarters? So finally, with a new CEO, they got religion and set a bar that they could beat. So they're talking about slowing, continuing next year. Nike, similarly, they missed the last couple of quarters. Inventories rose. They're paring down inventories. Frankly, if we had every company report a disappointing quarter or quarters prior to what we're going to see in the fourth quarter and set those bars so low to reset, then I'd be bullish. But that's not the case. What we're going to see going forward is that companies are going to miss and earnings in the S&P going to decline. So we've seen these kind of pops before because, let's face it, markets go up most of the time, 90% of the time, and people are generally bullish. People are generally optimistic. But this rally is going to fail. It's the late Christmas rally occurring, 2 days before Christmas. So it came much later than people expected. I don't think it's sustainable. In terms of China pushing Russia talks, well, let's see how that works out. I don't think Putin's going to kowtow to Xi or anybody else. He's got to figure a way to get out of there, and he wants the territory.
But it was on the tape. But it was on the tape, Stephen. That's why I brought it up. It was on the tape. People were talking about it. I had traders sending it to me. You have this J.P. Morgan quant fund, which is way too wonky to go into, but you know what I'm talking about, that may be driving a bunch of call option buying because this massive rebalancing.
Yeah, it is massive rebalancing. That's what we'll see into the end of the year. It's a quarterly rebalance, and then it's on steroids because it's annual rebalance, and you have to adjust for definitely your 60-40 portfolios, meaning fixed income, your credit, and your equity portfolios. Get through all that noise, though, and what you've got is a slowing economy, and you can't fight the Fed. You can't say, I'm joining the Fed when the market goes up and it's free money, and say, no, the Fed's not going to be right in declining, in hitting the economy, declining jobs. So I'm still bearish.
Sure you can. Have you been on social media, Weiss? You could change your views every single day and justify it. It's like a national hobby at this point. All right, Brenda. I need my heart to grow 2 sizes too big. I'm a little bit grouchy today. There's no way Nike's mildly better than expected earnings are driving a 500-point move in the Dow. Is there? I mean, is that literally it? No way.
Well, I think it speaks to just how negative things have become, right? Over the last several weeks and even throughout much of this quarter, we've had strategist after strategist come out, talk about how horrendous earnings are going to be in 2023. We have a consumer sector that's really over inventoried. So I think hearing from Nike, clearly a bellwether within that group, that, things aren't as bad as everybody expected. And by the way, the inventory clearing process is going a little better. Maybe if we look through to other names within that group and assume that, maybe the inventory problem will be behind us, mostly behind us after we get through the holiday season, that maybe things aren't quite as dire as we're expecting that they might be next year. So I think there's a little bit of that at play. Obviously, it's one day coming after several down days, so a little bit of a rally, but nice to see that positive fundamental news.
And Jenny, there will be talk about, earnings recessions, et cetera. Evercore's annual note, by the way, notes that you can have earnings go down and stock prices still go up. We think that they must go down in tandem. That is not the case. Evercore points to 1970 and a few other years where earnings in the S&P went down, but the markets overall went up. What is your take on the numbers that we have seen and what we should expect out of earnings, a quote, recession, and the markets?
Well, I think if earnings go down and the market goes up, that means you've got the valuation, the multiple improving. And I think when we're at 17 and change times, which is what we're at right now, I don't think that's a likely scenario. I don't know what the multiple on the market was in the 1970s, but I'll bet it was a lot lower than it is today. So if the market were at, 13, 14 times right now, I would say, sure, that's plausible. Earnings could go down, and maybe we get back to a 15, 16 times multiple. So I don't think that math works anymore. I'm actually more in the Steve camp, which I hate, although I don't share his level of pessimism. But I look at this period that we're in as one of enormous recalibration, mean reversion. We are digesting 10 years of excess valuations, excessive behavior, excessive liquidity, and we're digesting that.